Subscribe to our YouTube channel and press the bell icon to get the latest updates.
In 1994, a 30-year-old Jeff Bezos was vice president at a prestigious hedge fund in New York City. One day, as he was researching markets, he came across a fascinating fact. This fringe thing that people called the internet was growing at an incredible 2,300% per year. Immediately, the opportunity alarm bells went off in Bezos' head. He thought to himself, things just don't grow that fast. The internet must be a once-in-a-lifetime opportunity. Now put yourself in Bezos' shoes for a minute. How often do you spot such massive changes? And how often do you take the plunge to act on such a change? Well, as we know, Bezos did, and the rest, as they say, is history. Now, it's not always easy to spot such big changes. If you're waiting for the media to write about it and for people in your network to talk about it, you will miss the biggest opportunities. Counterintuitively, many of the biggest ideas look like toys at first and are almost universally ignored or written off. For instance, if we look at what happened in the US markets over the last 50 years, we see that earlier, majority of the index constituents belong to the non-technology sectors. Look at this table of the 10 biggest American companies of the 1970s. You barely find any technology stock here. Most are from sectors like oil and gas, retail and telecom, the dominant sectors of the times. These companies were thought to be the unbeatable companies at the time. Almost everyone thought the stock prices of these companies could resist any market correction. But just look at what happened in just few decades. Some of the biggest companies faded away. They eventually went bankrupt. Others had to sell assets to survive or take bailouts from the US government. Eastman Kodak, Polaroid, Texaco, Sears all went bankrupt. Even mighty General Motors had filed for bankruptcy. Gulf Oil and Standard Oil were saved by mergers. Who would have thought that the most powerful companies of the United States would be wiped off from the face of the earth in just few decades? But it happened. Now if we look at the top 10 American companies on the benchmark indices, here's how they look. As you can see, all 9 of the 10 big companies today are technology ones. You can observe a similar trend in China too over the past 20 years. So the change is the domination of tech stocks in the benchmark indices of the developed economies. What happens with such a change is that the pace of technological innovations gets steeper. So tech companies typically follow what is called S-curve in their life cycle. But as the pace of innovations accelerate, the gradient of the S gets steeper, like this. And therefore, it is important that you spot the change in innovation and technologies at an earlier stage to be able to ride the upside. If you want to know how quick do tech companies get obsolete, look at this. It shows top internet companies in the US every 5 years since 1998. And if you see, barely few names like Microsoft, Google, Apple and Amazon are around today. The rest have faded into oblivion. Now what you need to do here is study a bit of history, the history of innovations over centuries. The chart here maps major technological breakthroughs in the last 250 years and their economic impact. I love it because it really captures how unique this moment is. The invention of the steam engine, telegraph, telephone and computers were over a gap of many years. But of late, the innovations are literally piling up over each other. It looks like a tidal wave coming at us, and in many ways, it is like a hockey stick. In fact, I call it the hockey stick rule to finding disruptive businesses. So, the last 2 decades have seen a rapid spurt in innovations world over, and it is very likely to continue. But looking for change or innovations is not enough. Speculating on such trends is fraught with risks. So, you must look for proof of sustainability and profitability. For instance, this chart shows how the so-called FANG stocks in the US have managed to nearly triple their share of market cap in the US over the last decade. But was all of this fluke? Did the companies get the market cap out of nowhere? Not really. For even in the COVID times, there are companies that witnessed the maximum surge in their revenue and operating income. So it is the resilience and the downside protection in the disruptive stocks that matters. What you also need to understand is that the method of valuing disruptive businesses can't be conventional. The traditional valuation multiples like price to earnings and price to book value are not ideal for valuing the upside in disruptive stocks. Being disruptive businesses, such companies have a majority of their assets in the form of intellectual capital, patents, R&D edge, new product pipeline, etc., which do not get accounted fully in the balance sheet. But most disruptive companies work in an ecosystem where they liaison with larger and larger networks of players as the businesses get bigger. So what you can see in this slide is a network of food delivery company Zomato and ride-hailing company Ola Cabs. Both these networks lend considerable value to the businesses. Plus, they have what is called optionality plays. For instance, InfoEdge has stakes in Zomato and Policybazaar, both of which got listed in 2021 and fetched big returns for the shareholders of InfoEdge. Comparing Indian companies with global peers can also give a sense of how these companies could function once the markets become more mature. Therefore, to accurately apply the hockey stick rule, pay attention to what stage of the business and profitability cycle is the disruptive company in. Tata Elxsi, for instance, spotted the opportunity in AI, which is artificial intelligence, and electric vehicles almost a decade before the idea became mainstream. TCS created a remote learning interface well before the pandemic struck. Both the companies were already on solid ground in terms of financials. But the inflection point was the pandemic, which allowed these businesses to prosper much more than their peers. So do not let high growth opportunities slip away for want of historical evidence or low PE multiples. Rather, stress test the companies to see if they can handle rapid technology catalysts. The easier it is for the businesses to overcome changes, the better they are to follow the hockey stick rule. Hope you like this video. Stay tuned for more such videos on the safest and most appealing permanent wealth stocks.